Hello everyone, welcome back to my channel. So this video marks the end of the week number 89 in this road to 100k realized return challenge, and more so that on many other occasions this was a week of two halves. The week was basically split into two according to what happened in the war waged by the US and Israel against Iran. And the turning point of the week was late on Tuesday, April the 7th, where the U.S. administration announced a ceasefire, and so the threats of blowing Iran off the map and back into the Stone Age never materialized, and markets I should say breathed a huge sigh of relief. And looking here, for example, at the Qs, this was basically a week of two halves. As you can see, the big turning point was in here. And once the ceasefire was announced, already after the market closed on Tuesday, markets opened on Wednesday with this huge gap above, and basically remained this way until the end of the week. Basically the hopes that fueled by the hope that the ceasefire and would eventually translate into the end of the hostilities. Even so, the ceasefire was not has not been what is supposed to be. The Strait of Hormuz is still partially closed. There are a couple hundred of vessels still parked in the Gulf, and there has been also, if I'm not mistaken, there also been some rumors that, or some news pieces that came out that the ceasefire was already violated. But yeah, markets did not pay too much attention to that. They basically continue to hope that this will eventually mark the end of the conflict in the Middle East. But that's basically what came out in terms of the geopolitical news. In terms of economic data, which given the circumstances have a little bit less of a weight in the market behavior at this point. But I would say that, yeah, even though ISM services gave this result of 54%, signaled an expansion a bit less than what was forecast, but this pales in comparison to what was going on at the time in the conflict. And I think basically the real data and the important data that came out started on Thursday. Not so much personal income or personal spending, even though personal income came down a little bit and spending went up, understandably so, given the inflationary pressures that have, of course, are resulting from the war in Iran. But then the PC index, the personal consumption expenditures, which is, as is widely remarked by the news media, it's the preferred measure by the Fed to make as a basis to make these decisions on interest rates decisions. And it came out in line what was expected, but also because it continues to be quite elevated, especially in terms of the core. And the only having a deeper look into this, it appears that discounting the food and energy prices is higher than the headline. And I think understandably so, because food and energy have lesser substitutes. And so PCE is different from CPI because PCE accounts for the substitution effect and reflects the consumer changes in the consumption changes of citizens and consumers, because as prices change, and PC accounts for that. That's why it's a preferred measure. But because there are more choice in other products other than food and energy, and food and energy are less alternative. They are essentials, and there are no alternatives to them. When they are discounted, they yeah, basically they bring down they bring up the core inflation. And so this is something that continues to be a problem, and because it continues to be quite elevated. And also, another bad news was the GDP was further revised down, and from 0.74 to 0.5. Apparently, the reason for that, and looking here at the news piece when this came out, is apparently that the investment came out a little bit, was revised a little bit more downward here, as you can see, lower investment than previously indicated. And so, yeah, again, this is more bad news for the US economy. And jobless claims came a little bit more above what was expected, but not that significantly higher. And when it comes to the consumer price index, again, as you can see here, actually these are not the numbers, but I have the news piece in here. The consumer price index rose 3.3% in March from a year earlier, so 3.3, yeah, this is, of course, also significant. This is up from 2.4 in February. Doesn't say anything about the core, I think. There must be somewhere in here, but yeah, it's still elevated. Let's see right here. Yeah, let's put in the, yeah, 3.3 and 2.6 in the core. So again, this is of course, it's a worrisome situation. And here, looking at this picture, you can see the breakdown by items, what basically increased more in prices, and predictably energy led the way, especially gasoline and energy overall, and also airline airfares, tobacco, motor vehicle maintenance and repair, and also food, some food items, yeah, fruits and vegetables, non-alcoholic beverages, and materials. So yeah, this continues to be a problem in every possible way. And with this in mind, it's, yeah, this is not this as you can see, this did not play much of a role into investors' behavior, because the market simply did not pay too much attention to it. All they are caring about at this moment is the war in Iran, and yeah, that's probably the way it's going to be, even for next week, because next week, looking here, we're going to have the PPI, and I expect that this will also not be much of a market mover next week. And we have some Fed speak, yeah, but we have nothing else. So yeah, PPI is going to be the main information, the main economic data that will come out next week. So that's pretty much it from this perspective. Now, when it comes to the trades that we did, and looking here, this was quite a lean week for us. We only managed to accrue a little bit less than $452. And yeah, this is the correct, because these are only the positions that were closed or expired, or in the case of NVIDIA, assigned this week. And so looking back here at the trades that we did, as you recall from the last video, we sold a put on IWM here at 242, and we also let this, that's the only trade that we did, by the way, and then we let this call from NVIDIA expiring because yeah, it had no value. And we were hoping at the time that, all right, the price was hovering around 177, 178, and given that situation, there was some hope from me, Here you see it closed Monday a little bit below 178. There was some hope in my case that the price would go up for to start the day on Tuesday, and we would be able to sell a call with a higher strike price, or even if we sell one at 180, we would be able to collect a higher premium. But the stock started the day coming down, and I felt that it was probably our best bet to sell another one for the entire week at 180 again, in order to capitalize on the volatility that would come from the PCE and the CPI here on Friday. However, given what happened from the geopolitical front, this ended up being a lost opportunity, because once the markets opened on Wednesday, our strike was basically overshot completely, and from this point onwards, the call that we sold was always in the money, and the stock ended up the week close to 188. And so even if we could even had sold a call on 185, which was our usual price when we got initially assigned, and we could have made $500 in capital gains. Even 187.5 would have resulted, but of course I would never use this strike price to begin with, given where we started this position. But still, it turned out to be a lost opportunity. We could have earned a lot more, but this ended up not being the case, and as a result of that, we sold the shares. We broke even, because as you recall here, we sold 180, but we bought these 100 shares also at 180. And here is the total amount that we collected in premiums, 1,165.47. This is our profit, 0 capital gains, and this is pretty much it when it comes to these 100 shares of Nvidia. Now, all right, so we are in, no, it's good. So going back here, so we sold this put. We bought back the puts that we were having here on the ARKK. And why is that? We bought this on Wednesday because when the markets went up so much all across the board, that these puts became, as you can see, almost worthless at 3 cents, and we bought them back at 3 cents, even given the illiquidity that these options have from the RKK. And we did it 2 days earlier, so because we did this on Wednesday, so we bought those back. There was no point in waiting 2 more days to accrue these 3 cents per share. So it was, basically we bought everything back, and we also bought back this put on 242, the strike price that we sold here. So this ended up being quite some good trades for us. Here the IWM, we pocketed almost 44%. The puts on the ARKK, which are over here, not so much, 15, 19, and 22. So not as good as it could have been. But if we let go until maturity, the return would have been worse. Also, because this was a relatively low profit, because as you can see here, these were 3 delta and 5 delta puts. So that's also the reason why the return was so low. I think the return was still good given the probability, how far out of the money they were when we entered the position, but we wanted to really make a dent in our cost basis, and we used these proceeds from these puts to sell 2 puts at 250 on IWM. We received 26 cents a piece, and the next day at the end of the session, So on Thursday, because the market remained at that level and even went slightly higher in just a matter of from the beginning of the session on Wednesday until the end of the session on Thursday, we managed to buy back at just 2 cents. So this was also a very good trade for us, which is right here, and we collected 16 cents. Now, not that much on paper, but keep in mind this was a 3 delta put because we really wanted, if the market collapsed because someone broke the ceasefire or something bad would happen and the market collapses back to where it was, we would be able to capitalize on that and really bring down our cost basis, which is currently 266. I made some calculations. If we bought these 200 shares at 250, our cost basis would be 258. So it would have been a big dent in the cost basis, but it ended up not happening. The market sustained itself, and we took the opportunity. We with this collateral released from these puts on IWM, we were aggressive but with a calculated risk. We went ahead and sold 17 puts on the junior silver miners. We received 5 cents a piece, and we did it again with a 3 delta put with a strike of 29.50. And with this, you can see we also received, because we let this expire yesterday on Friday, we received almost 30% in return, which is very, very good for a put that was so much out of the money. The price would needed to collapse by more than 6% from the price at the time to 29.50. So this would mean a more than 6% drop. And yeah, what are the chances of that happening in one day? They were quite remote, judging by the probability of profit of this put. So yeah, it ended up going quite well. We received only 5 cents per share, but we received this. It represented this return because it was only one trading session left, and we let everything else expire. So these puts expire worthless. These ARKK puts from the previous week also expire worthless. The price never been in question. The strike price was never even close to be approached. Even the ARKK even receded a bit as the news of the ceasefire came out, because there was this big jump and then the price just came back. The maximum that it reached was during the opening instance of the session on Wednesday after the ceasefire was announced. So it went close to 73.5, but then it was just pretty much a downhill from there and all the way until 69. So the calls were very much out of the money when they expire. And so yeah, we assigned these shares of Nvidia, 100 shares. We sold them at 180 and we got this money back, and that's why currently we have almost 60,000 euros in cash to deploy next week in puts. Now, having said that, and I thought about this, what should we do next given the situation of the market at this point? And I thought about two potential alternatives: either selling puts on IWM, ARKK, or using all this money to sell a put on the Qs to try to bring them down in terms of their cost basis. I thought about that, but IWM is pretty much out of the question because it's not that far from our cost basis, which is 266. So even if we use this money to sell two puts, because we can only sell two puts with this money, we would not be able to make much of a dent, and unless we go really, really for puts out of the money, and we receive very little premium for that. So I don't think it's worthwhile. For ARKK, we could also do the same. We could go for a 61, 60 put, but we won't get as much money, and it would be nice if we see them. If we want to really reduce our cost basis, it would be nice to see the price coming down to 65, 64, to be able to sell puts at 61, 60, and or even 59, so we could get a good premium and meaningfully lower our cost basis. I decided that selling one put on the queues would be pretty much a bad move because, first of all, one put is not going to make much of a dent by itself unless the price goes really, really low. And we would tie up all of our money basically, because each put would be sold with a strike price of around 600, so all of our money would be tied up in the queues, and we would not be able to do anything else. And so I decided that, all right, given the money that we have, let's maximize our premium collection, and that's why next week, of course, we're going to sell again our calls on the ARKK again, our 3 calls with a 75.5 strike price. But still, we are going to maximize our premiums by investing or by selling puts again on commodities. The SILH probably will do something in this copper ETFs again. This is one that for me is quite appealing. It has a low price, also 42 is quite feasible. I also had a look at this one. This invests directly in gold shares, because this invests directly in gold, but because it's an ETF, of course, it's represented by shares. So keep in mind that there's only an option chain for a week, all right? And these ETFs are quite illiquid, so chances are we're not going to be able to buy back these options profitably unless there is a really strong appreciation of the price. But it's not a problem. We still managed to collect a significant amount of premium, and so we are going to focus on this to make sure that we maximize our chances also to get as much premium as possible. And again, considering the challenge that we have ongoing, we are still quite a long way away from our objective. I made the calculations. We are still a bit under 82,000, and so because of that, these are some of the commodity indexes. These are equities, by the way, but these ones are actually on the actual metals. But I decided, all right, let's maximize this strategy in order to get things moving, because if the market goes up, these positions on the RKK, AWM, and the Qs will solve themselves up, because the calls eventually will be assigned, and so that's the way we are going to proceed for next week. Before we wrap up, and given this inflation, the CPI and PCE data, the upcoming meeting for the Fed, almost uncertainty, the rates will be kept steady, although the Fed funds futures are also pricing in a 2.1% chance of a 25% point increase, which I think is extremely unlikely, even more in the context of the GDP for the fourth quarter was further revised down, and so I don't see that there's any chance whatsoever that a 25 basis points increase will be under any consideration for the next meeting. And this is pretty much it. feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And we will reconvene either on next Monday in the evening or Tuesday morning to start the week number 90 in this challenge. And I'll see you there.